So, tariffs. Who pays for them? The exporter, the importer, or the end consumer?
Everyone pays.
Hey everyone, welcome back to another episode of WSJ's Take on the Week. I'm Telis Demos.
And I'm Gunjan Banerji. So tell us, I still can't stop thinking about that Oracle move.
It was bonkers, right? Because we're talking about an already very big company, and the stock went up
Around 40%.
around 40%.
That's a meme stock level move, right? Like, big technology stocks aren't known for moves like that.
But meme stocks are like, sub-billion-dollar market cap. Like this trades for 50 cents and now
Zero
it goes
profits.
to $1.50. Like we're not talking like, blue chip, gold star, established companies making moves like that.
Right. This is a company that's now one of the 10 biggest companies in the U.S. by market cap, which is just wild. And basically, they had this earnings report that really wowed investors. And to me, there were a few big takeaways. One, the AI trade is so not over. I feel like a few weeks ago, everyone was freaking out. Has this thing become a bubble? Are these gains in stocks like NVIDIA and the tech behemoths, are they overdone? And I think this showed us that people are still wowed by AI and big tech right now. And two, it feels like some of these crazy $100 billion, $200 billion moves in stocks like NVIDIA, Meta, Oracle have kind of become more common, right, for these big tech stocks to trade like crazy.
Well, I want to talk about what drove the stock a little bit, though. But it seemed like what moved the stock was that they announced essentially a future revenue projection that was multiples of what Wall Street was expecting. And that is being driven in part by things like they're signing a long-term deal with OpenAI to provide them with computing services to power AI years into the future. A couple of things that our colleagues on Heard on the Street, Dan Gallagher and Asa Fitch, wrote. Number one is that it's one thing to have contracts in place and another to believe you will be able to collect on them years down the line. So while this is about revenue, right, this isn't, traders hallucinating on behalf of an AI hallucination. This is like, okay, they're talking about revenues, but it is not like money in the bank yet. It still suggests that there is something speculative about this trade, right? It's not like dollars being made today. To me, that makes it still feel, I don't want to say bubbly, but optimistic.
It's just like, it's hard not to be like, are we getting ahead of ourselves? And I think you saw a lot of people getting ahead of themselves in trading after that earnings report. I mean, we've talked a lot about call options trading, right? These are leveraged bets on where the stock is going to go within just a few days. And I saw people turning to like some of the most bullish trades out there.
Yeah.
But just to, play devil's advocate a little bit, I think there is a lot of money in the bank in terms of the tech trade.
Okay.
I think this shows us how people have been so worried about concentration in the market, right, among these big technology stocks. But these are the stocks that keep delivering for investors. I was looking at a Deutsche Bank stat and it said that since late 2023, big tech has contributed nearly 90% of all earnings growth since then. So people are really relying on these stocks.
Well, and to your point about concentration, the fact that it's Oracle making this move and not one of the Mag 7, there's a broadening happening, right? Like if you look at the leaders of the S&P 500 this year, you see a bunch of tech companies, but here are their names. And these are, for those of us with a gray hair or two, like these names have been around for a while, right? Seagate, Western Digital. I mean, those are like spinning disk hardware companies, right? Oracle is up there in the top 5. And then, a couple of the others are something we've talked about on the show before, energy companies, right?
Yeah.
The energy to power AI. You've got GE Vernova and NRG. So there is a broadening happening in that regard, right? But I do take your point about how something about the way people trade these days, using a lot of derivatives and other things to magnify market moves. I mean, that still is, I think this says both, right? That there's a real economic shift here happening towards the, kind of future AI economy, but also that the market is in a place where things like that happen just because of the way people are just, pedal to the metal in the way they trade these days.
Yeah, it just feels really momentum driven. And again, I think the big takeaway is that this AI trade is just not over yet. Though maybe in the coming week, I think people will be paying a little bit more attention to the Fed.
Yeah, I mean, I know the Fed sounds prosaic compared to AI, but also, of course, everything going on with the Fed is pretty wild these days. Obviously, you have the sort of political cloud around it, having to do with, the president seeking to oust one of the Fed governors. We'll see how that plays out. But even just like the actual like day-to-day work with the Fed is really tricky right now. And it goes back to the classic tension between their dual mandate, right? Keeping prices steady and also pushing the economy toward full employment.
Right now, it looks like the jobs market is certainly weakening, right? This is not the hot jobs market of the pandemic or post-pandemic days.
Yes. You had, obviously, the soft labor report from a couple weeks ago. You had another revision report this past week that revised down jobs. Kind of a lot of it was even before Trump was in office. But anyway, the headlines of the labor data are all pointing kind of in the wrong direction right now. However, inflation hasn't gone away. The Consumer Price Index report this past week was not hotter than expected, but it did continue to go up. So it was at 2.9% year over year for the headline, 3.1% year over year for the core. That was like in the neighborhood of where economists were expecting it, but it's still ticking upwards. And we know that the expectation is that the Fed will cut in September, whether it's 25 basis points or 50, a quarter point or a half point. We'll see. But I want to point out a couple of things. One was there was a really interesting story in the Journal about lumber prices kind of flashing a warning sign, right? Companies not, expecting to be building as much. You talked to Neil Dutta, a couple of weeks ago about the housing market in a recession.
And, I asked him, can the housing market be in a recession without the rest of the economy falling into a recession? He said, not really. That's very unlikely. But what's happening in the lumber market, I think, is so, so important and can have such a ripple effect, right? Like, if you think about it, if there's less demand for lumber, that means potentially less demand for homes, right? What happens when people don't want to build homes? That construction worker might not be getting a job. What happens when he or she doesn't get a job? They might have less spending money for that dinner out on Friday night, which can really weigh on our economy. So I think that one metric just has insane ripple effects across the entire economy.
I tend to agree. And if you look a little deeper into the inflation data, you saw that the producer price index was slowing in its most recent report. And so you have, producers not being able to push through, wholesalers not being able to push through price increases maybe means that they see weakening demand. And so really, I think the focus is now on the business side of the economy, right? What is going on with companies amidst, tariffs being the main driver, but other things happening in the economy. And the vital question that remains as we debate, inflation versus jobs is, will tariff-related price increases be something of a one-off, and that the Fed should really turn its attention to kind of promoting growth in the rest of the economy to prop up the job market? So in order to look a little deeper into this question of like what are companies thinking about right now when it comes to their business, passing on prices to consumers, how able to do that are they? We decided to talk to somebody who's a little closer to the front lines of, working with importers and exporters and sort of helping them work through this and figure out how to adjust their businesses around what's going on with tariffs. And that's Adoniro Cestari. He is the head of trade finance and working capital at Citigroup, which is a big global bank that obviously plays a large role in the financing of the movement of goods across borders. It's a really interesting conversation, and we're going to have it right after the break. Welcome back. We are joined now by Adoniro Cestari, who is the head of trade and working capital solutions at Citigroup, which really as a bank is one of the global leaders in kind of the business of trade finance. So we're getting kind of an interesting perspective here on what's going on with trade and tariffs and all those sorts of things. Adoniro, welcome.
Thanks for having me. A pleasure to be here.
So here we are, more than 5 months out from Liberation Day, when President Trump first laid out the reciprocal tariff regime, which really was kind of the first of its kind and marked a very dramatic change in how the U.S. has typically, thought about tariffs and trade for, the way it's been done for many years. And yet 5 months out, we don't really have much more certainty about what exactly the tariff regime will be, because some of it was thrown into question by U.S. courts, which have said that President Trump can't do some of the things he wants to do. Now, the Supreme Court will weigh in. But how would you say your business and your clients are dealing with that degree of uncertainty for something that really, I imagine, represents a sea change in how people do business in trade and trade finance?
I would say that the first reaction was kind of a stop. And I would say that most of
You mean
the
the first? You mean
clients-
back in February when this first?
Back in February,
Okay, yeah.
there was a first initial reaction of accelerating purchase. So
Yeah.
you saw the data shows a lot of acceleration in accumulation of inventory. There was deals made to source critical equipments for AI farmers and things like that, which was happened right just before the first tariffs went in. And then I would say that is yet a wait-and-see mode for the most strategic decisions, right? So big factory build-ups or big reshifts on who I purchase or not, because there is yet this deals to be made, temporary deals which are still being done. But the good thing is that I think the expectation or the noise in the market has reduced because I think people realize that the levels of tariffs are going to be much more sustainable than it could be.
Okay.
And
meaning that at times people were thinking the tariffs might be north of 100% on some things. And it looks like they're not going to be
exactly
close to that.
Which were not sustainable, right? So that will cause. And with the deals being made, I think that shows sustainability in a lot of the supply chains we're seeing. We're seeing clients focusing a lot on efficiency.
Okay.
So clients have factory here and factory there.
Yeah.
And just by rerouting some goods from one side to the other, they have less impact on tariffs. Of course, they are doing that.
Okay.
Clients, which is easy to replace suppliers because of the nature of the goods, they are doing that, right?
Yeah.
And since COVID, there was a natural trend in diversification of the supply chain.
Okay, so we had a trial run, essentially, right?
I would say if we are in this situation without the evolution since COVID, I think people will be much more concerned. But the China Plus One strategy has been on the table for a meaningful time, and people have really did good progress on that. But the concept of nearshoring and the concept of really changing dramatically supply chain, it's a long and costly process, right? And even more in specific industries where there is technology and knowledge to be created to enable those.
And real quick, it's a term that gets thrown out there, but China Plus One, what does that refer to?
It refers to the strategy of intentionally diversify your supply chain exclusively from a concentration in China, right? So clients really looking for keeping China, but expanding to alternative sources of supply chain.
Well, I want to focus on something you said before, which is efficiency. And that's a really big idea because when we talk about like who pays for tariffs, we always talk about it in very explicit terms, right? Okay, there's the exporter, they pay it at the border. There's then the importer who, maybe the exporter sort of pushes it out to, well, you're going to pay for this by paying more for this thing. And then there's the end consumer where maybe the importer says, okay, well, we're just going to charge you, consumer, more for this thing which has moved, across the border. But efficiency is a way for nobody to really pay for it explicitly, but for it to be paid for by changing how you make something, where you get it, how you finance it. So tell us more about what does that mean for your clients? Like what are trade clients of Citi doing in efficiency terms that mean that essentially nobody explicitly pays for the tariff, but it's paid for in other ways?
Yeah. I would say that with exception of very few companies which have a very simple business model of just repassing goods, all clients are very focused on minimize the impact to the end consumer. And with that, they go to all the partners, right? They go to the suppliers, then they push to renegotiate agreements. And they go to their partners on the logistics side and so on. And they go to the banks, right? And they look up, we need to reassess this. Or I'm thinking about building this, or I'm thinking about changing the supply chain from here to there. How can we make this more efficient? And that has been a lot of what we have been doing, which is benchmarking supply chains from one side to the other and helping our clients to thinking about how you leverage financial instruments to enable the supply chain be more efficient on that one, and that will drive efficiency. So my base case is that a good amount of the tariff impact will not be reaching the end consumer.
So, I mean, we've seen one indicator recently, I would say the jobs report, that hiring has slowed in the United States. Do you feel like that's a path to efficiency for some clients?
100%. I think really people looking at activities which can be automated and can be done by machines, by agentic AI. Clearly, it's a path to efficiency for every industry.
And what about the process of reshoring? Like people basically saying, you know what, I'm not going to import this anymore. I'm going to make this here, or I'm going to find a domestic supplier of this. Are you seeing that in your business? Because that's obviously the hope of a lot of these policies, right, is that it drives domestic investment.
Yeah. And most of those cases, those are multi-year investments and several billion dollars, right, depending on the industry. So I think, yes, the answer is we're starting to see more and more of that as those deals start to be perceived as more serene, right, more permanent than a negotiation.
So you are seeing those conversations happening?
We are seeing starting it more now than a couple months ago, I would say.
Interesting. So I guess the question that investors really want to kind of zero in on is who pays the tariff, right? Is that the right way to ask that question, do you think? Or is it more complicated than that?
I think it varies a lot by industry. All our clients are really focusing on preserving or minimizing the price transference on that. Not all client has the same footprint in terms of supply chain, and everyone is living on. It's not just tariffs, right? So to your point, it's the consumption power globally, and there is competition. So it's not an easy conversation. When you look at our clients, everyone, of course, is assessing pricing strategy. They're assessing some phased pricing conversations, some market tests, some selective pricing on products which has less competition and so on. But there is a lot of awareness and concern about pricing increase impacting the amount of the wholesales.
Yeah. People don't want to have to raise their prices to their end customer.
Exactly.
Right? The pattern we've seen with inflation data, I'd love your perspective on, which is that, the consumer price index has gone up a little bit when you look at it kind of year over year. What's risen faster in some recent readings has been the producer price index, the wholesale prices, right? So it seems like consumers are not necessarily being charged more overall, right? It's, there's a lot of different mixes in there. But producers are. So some people have looked at that and said, well, that's a sign that it's the producers, right? The wholesalers, right? Like I'm paying more for the stuff that I buy to make the thing that I sell to you.
Yep.
And I'm just going to absorb that and not pass it on to you. Do you think that is the pattern that will continue to play out, is to see producers paying more and just sort of eating it, or like you said, finding other efficiencies?
There is some temporary aspect on that. The supply chain, there is increases in cost today in the supply chain. People are looking to find productivity, ways to reduce their costs. But on the end of the day, there is so much that can absorb without impacting their shareholder value. So there is going to be some price transference. And there is yet some of those tariffs negotiation going on. So I would say that while there is tariff negotiation going on, people are really holding and taking some losses, I would say, to preserve their pricing strategy for some time.
You guys as a bank see a lot of transactions. What are you seeing in terms of payment flows or other things that sort of help lay out this kind of picture to you of, producers are kind of bearing some of the costs, consumers aren't necessarily feeling it in the prices. What are you seeing in those payment flows?
It's very difficult to get from those payment flows data in relation to the consumer pricing. So what we are seeing is some of reshifting flows.
Okay.
Right, we're seeing when we look at analyzing data, we're seeing places like Vietnam, Indonesia, India becomes like new manufacturing hubs.
Apple famously, of course, has for many years worked on shifting its production to India, for example, from China, right?
So I think several clients in terms of pharmaceutical and telecommunication that are leveraging India in that sense. And you see a lot of Chinese companies building those manufacturers there, right? So it's a mix of before. I think this age of tariffs was like a China plus one strategy. Now I think there is China plus one, and there is this regional manufacturing centers, which are all intent to really build diversification and alternatives in terms of not only tariff regimes, but geopolitical events, which I think has been part of the agenda together with this tariff regime.
And so as this goes on, one question that raises for me is, if interest rates come down, does that make it sort of cheaper to make some of these changes, or is it not that sensitive to interest rates, the kind of the trade finance business?
It does. I would say that interest rates going down, it will incentivize suppliers to draw on facilities, and really the conversation around tenor concessions, pricing concessions on end goods are impacted by their cost of capital or the cost of financing, and we see the difference in interest rates across the globe. Mm-hmm. It does impact the U.S. suppliers.
So is that something that would lower interest rates help your business? Like, do you think that would make these transitions, happen faster?
I would say that it will generate incentives for more solutions and for some of those win-win situations to close, right? As if they are not getting the mathematics today, the cost of capital, the cost of access to finance, it is an element of that calculation, and interest rates going down is going to enable more trade activity, which naturally generates more activity in my business.
So would lowering interest rates actually maybe lessen the price impact of tariffs on consumers, do you think? Because then companies could pay for some of these adjustments?
It does, right? It's not a direct one-to-one, but it is part of the component. Right?
Interesting.
If you look at the cost of any company, cost of debt it's a relevant cost.
Yeah. Well, it helps paint a picture of the totality of economic policy, maybe.
Yep.
All right, well, we're going to take a quick break, and when we come back, one last question for Adoniro Cestari of Citigroup. All right, welcome back. We've got one last question for Adoniro Cestari of Citigroup. So, tariffs. Who pays for them? The exporter, the importer, or the end consumer?
Everyone pays.
Everyone pays. How so?
Companies are sharing the pain and really pushing their partners and their banks and everyone to bring efficiency and productivity or support in these times to reduce the impact on the end consumer.
I didn't think global trade was simple, and talking to you about it has confirmed that. But it is obviously a hot topic, and we've all had to learn a lot more about it recently. So it's great to hear from somebody who's been living and breathing it for a long time. Adoniro, thanks so much for joining us.
No, thank you. This is our bread and butter every day. Try to help our clients navigate this volatility in the market. So I'm very happy to be here.
So tell us, I still can't stop thinking about that Oracle move.
I mean, it was wild, right? Like, everybody forgive me, I don't remember the number exactly, but it was a, 30, 40% move in an already very large company, right?
Right.
All right.
Excellent point.